Good afternoon, ladies and gentlemen. Very, very good afternoon. We're here at the Hilton Hotel in Port Moresby, and so I welcome all of you who have dialed in to the webinar, as well as those who are watching on live stream, Facebook live stream on the Chamber's Facebook page. My name is Richard Kassman. I'm the Vice President of the PNG Chamber of Mines and Petroleum, and I'll be facilitating our conversation today. This is the Chamber of Mines and Petroleum's September webinar, and we plan to run this on a monthly basis. You will recall that in our last webinar, we had our guest, the Minister for Petroleum and Energy, Honourable Karinga Kua, who spoke about the reasons for the government embarking on reviewing our resource laws across both the mining and petroleum sectors. Honourable Kua had undertaken to participate in today's webinar. In fact, we moved the webinar from Thursday to Monday today at his convenience, but he has unfortunately given his apology and won't be able to attend the webinar. Nevertheless, we do have Minister Kua's on audio on our website, and we will encourage people who want to listen directly to the Minister to log on to the PNG Chamber of Mines and Petroleum website, and you can hear him there. The key purpose of this webinar and the objective of today was really to continue to engage with the government, to provide Mr. Kua a platform to engage with both the Chamber and, importantly, the wider stakeholders in Papua New Guinea, the general public of our country. But for his reasons, he's not here today. So we decided to proceed with the webinar with our panel, which includes John Chambers. John is with Santos and a member of the council. Philip Somare. Philip is with K92, former Managing Director for the MRA. And also Mr. Vaughan Mills. He's an experienced senior lawyer with Cause, Chambers and Westgarth, with tremendous experience in law in Papua New Guinea. And we've asked Mr. Arthur Somare. Most of you in Papua New Guinea will need no introduction, but it is real. We're really pleased, Arthur, that you're able to join us. He's here in his capacity. He's a former Minister of State, a very experienced Minister of State and Member of Parliament. Importantly, Arthur was leading ministry in the development of the PNG LNG, and he'll bring to this conversation that experience and background, and a wider background just as a leader of our country. So we welcome you, Arthur, and thank you for coming in at very, very short notice. So the format, ladies and gentlemen, is that I'm going to ask some questions of each of the panelists. They'll speak for 10-15 minutes, and then we'll go into a conversation. And I really want to encourage a conversation, and the discussion will go as the topics develop. I'll allow a little bit more freedom as we go through that, but we do have some structure in the discussions. So, John, I'm going to start with yourself. In our last webinar, Minister Kua made it clear to us that the state of Papua New Guinea was struggling to fund its participation in projects, and he made reference to the debt to GDP ratio. And Arthur, just putting your notice, I'm going to ask you to expand on that a little bit as well. But in the context, John, of how Minister Kua proposed that, he said that it's important that Papua New Guinea moves to a production sharing contract system and away from our existing royalty tax system. So, John, why is the industry pushing back on this, particularly since the systems are well established in oil and gas industry worldwide? This is the PSC system, John.
Yeah, Richard, thank you very much for that and for the introduction, and thanks to my other panelists and other members, and particularly thank you to the dialed-in audience on this webinar. I think a really important time for Papua New Guinea, and there's been a lot of rhetoric out there, a lot of it not always so well informed, and I think we've got a great opportunity at the Chamber to try and put out some more balanced information. And I think this debt to GDP thing is really, really important for any nation, but particularly a developing nation like Papua New Guinea. And what debt to GDP is, it's just a simple fraction, the amount of debt a country has over the gross development GDP, basically, which is pretty much the ratio of your debt to your economic size. And there's a simple way to solve it. You can pay off debt, and that will obviously help because you make the numerator smaller, or you can grow GDP, which is probably the preferable way to do it, to grow your economy without taking on too much more debt. And that's probably the way most nations would want to go forward, rather than freezing their economy and just trying to pay off debt. It's very hard to pay off debt if your economy isn't growing anyway. So in order to grow your GDP in a nation, I'm taking a bit of a roundabout talk about bringing PSCs, but to grow your GDP, you've really got to get investment in your country. And you can do that from domestic sources or from foreign sources. But really, countries like in the region, like Australia or Singapore, Indonesia, they've all been very, very successful at attracting foreign direct investment. And that's how they've really grown their economies and got them to a point where they have a very large economies that they can actually invest internally as well. And so what we're really talking about with all these changes is how does PNG really grow its economy effectively, still attracting the investment, but getting the split right so that the state is getting a fair share of its resources benefits. And that is the challenge, and it's not an easy one. But rest assured, to all my friends in Papua New Guinea, this isn't something that's unique to Papua New Guinea. Every country in the world has the same debate all the time. So there's always an argument about what is a fair split to the investor versus the government and the people of a country. So you're not alone in this debate, and it's a complicated one, and it does take a little bit of understanding. So I'm going to talk a little bit about how PSCs work, the pros and cons of them, and why as an industry perhaps we quite like the existing royalty tax system, why we think it is actually a very effective system for Papua New Guinea in attracting investment and also getting very reasonable splits to the people and the state. So let me park that for a while, get back to that. But just as a bit of a context about myself, I'm the general manager for Santos in Papua New Guinea. I'm certainly missing my trips up to Papua New Guinea because of the COVID travel restrictions. I sort of really hope everybody's getting on well up there. I've just had to sit through a very cold winter in South Australia without those regular visits, so that is disappointing to me. But my career has been one that's been spent mainly in developing countries throughout Southeast Asia and South America. And I've worked in a variety of regimes, but mainly perhaps in production sharing contract regimes. So I'm very, very familiar with how they work. I've worked in Indonesia, Malaysia, Vietnam, Bangladesh, India, Trinidad and Tobago in PSC systems, and a variety of other systems in other countries as well. So I'm not here to tell you that PSCs don't work. That would be not correct. But I'll make a few observations about them, more from a petroleum point of view. And Philip Somare, who's on the panel, I believe he's going to be talking a little bit later about their applicability to the mining industry. So to start off with, PSCs, they're an established system of how a state may run its fiscal system for resource industries, for oil and gas particularly, but they're not a panacea and that will give an increase in government take. Now that's the number one thing you've got to understand. If we're going to discuss moving to a PSC system, we really need to define what that system is. Every PSC defined is slightly different for different reasons in different countries, depending on risk and prospectivity and cost of operating in those countries. But if you get and it's very, very difficult to actually define the system completely correctly. If you get it wrong, you get no investment. If you get no investment, you don't get your GDP growing in your nation. And one of the things that we've seen and shown at the Chamber is that the direct government take in the resources industry that the government was getting in 2017 was about 20% was what the resource industry was providing of direct government take. We showed some slides as well in previous meetings where going throughout the 2020s, that would rise at least to 30% of direct government take. And at the last webinar, Sangratnam from Total showed us what the multiplier effect looked like, where there's 3 to 8 times the direct government take, particularly during construction phases of projects, that comes into a nation. So the value of getting projects up is absolutely huge, and they're way beyond what the government sees as direct revenue. It's all of the multiplier effect revenues where contractors, and whether it's caterers or trucking companies and other people, get involved in these projects. And that grows your payroll tax and it grows the opportunities for local people. And why we need to get this right is that if you don't get it right and there isn't investment, although we might be in the industry giving only 20 to 30% of direct revenue to the government, if you use that multiplier effect, it's probably more like 80 or 90% of the total activity in the economy somehow comes back to a resource industry driver. And we saw when PNG LNG was sanctioned that the GDP of the country actually doubled. And I think Arthur will talk a bit more about that later and how that impacted the country. But the critical thing is trying to get that space where we can get these projects up and running so we can enjoy the multiplier effect, and we can provide jobs and opportunities for a lot of people in country and grow that economy, particularly when you've got a population growth rate that's around 3% at the moment. So getting back to PSCs, they are complicated beasts, and you've really got to put a lot of work in getting them right. And if you're going to roll out a PSC regime, you have to have that piece of work already done so that investors can see what they're going to be up against. Now, how a PSC basically works is that it's a mechanism that allows an investor, who we'll refer to as a contractor, to come in, develop or explore first, find a resource, develop it. And then when production starts, you've got a mode called cost recovery mode, and then a second mode called profit mode. Usually, well, always, the point is that the contractor recovers his costs, his exploration costs and his development costs and his ongoing capital costs. And so what happens is that all the money that's been spent goes into a pool called the cost recovery pool. Now, generally, but this hasn't been defined in PNG, 80% of the revenue or more in the early stages of a PSC will go into into paying off that cost pool. So most of the cash flow goes to paying the investor early in that project life. And then as you get that investment paid off, you get into profit mode, and usually the split then flips, so it's more in favour of the state. So later in the project life, when the investment's paid off, the splits are bigger to the state. And the point of that is it's not too dissimilar to the present system that you've got in PNG, where in the initial years of a project, the state take is really through the Kumul vehicle, Kumul Mining, Kumul Petroleum. I'm more familiar with Kumul Petroleum, obviously. And in that first few years of the project, 22.5% goes to the Kumul MRDC vehicle. And then later on, as the project gets paid off, you also get tax coming on as well as that Kumul stake, which lifts you up 30% tax rate in PNG to around a 50% take. The PSC will basically do the same. The early take will be maybe 10% of the revenue during cost recovery, 20% of the revenue during cost recovery will go to the state, to the Kumul vehicle, and then later on, as the splits change, you'll get a larger share going to the state vehicle. And then that state vehicle has at its discretion, pays money into consolidated revenue or not. In most pure PSCs, the contractor won't be taxed, but there's variations on all of these things. Some PSCs also have royalties and some don't. So the important thing is to actually get to really better define that structure so investors know already what they're up against. Otherwise, it's going to be very difficult for people to invest. So you may ask, given that the position, well, what is the difference between the two? The big thing that's an advantage to the state, and Minister Kaur was quite eloquent in stating this, is that in the royalty tax system that we have in PNG, state, when it comes into the project, which is post-exploration, has to pay its share of the sunk exploration costs. And also, on top of that, the state has to pay its share of the project development costs along the way. Now, that's obviously led to problems in Papua New Guinea with how to finance that participation of the 22.5% equity in at least petroleum projects, and it would be 30% in mining projects. So the PSC seems like an easy mechanism to avoid that, because basically the state doesn't pay until it pays effectively out of production revenue going forward. My thoughts on that are that I think as an industry we need to recognise that this is an issue for Papua New Guinea, and I think Minister Kaur has been very consistent in stating that. But if you look at historically in PNG how projects have been financed, particularly if you go back to Kutubu, basically Kutubu was a royalty tax system, the existing system obviously under the Oil and Gas Act. And in fact, the PNG stake was actually carried by the developers and paid back out of production. So in a way, in royalty tax systems, you can actually build in this PSC mechanism anyway without having to really change things. And we've already done that on the Kutubu development. We didn't on PNG LNG, but on the Papua gas agreement, I believe, I'm not party to that, but I believe that there's been elements of that built into the Papua gas agreement. So I think the point of this is that if there is requirements that the state really struggles with, like funding of these projects, it is possible to use what we've already got in PNG and to negotiate that when we're setting up our gas agreements or our oil agreements, to actually work out how the state funding piece can be done through future production. So, so just park that for a moment. We might come back to that later. But getting back to why would the industry be concerned about production sharing contracts? And it basically comes down to efficiency. PSCs are not particularly efficient vehicles to work in or to administer from a state point of view or an investor point of view. And because of that, it means that they're inherently going to be a little bit less profitable because overall take is reduced, and therefore the splits between various parties, whether it's state or the investor, are reduced. But to expand on it a little bit, it's when you're working in a PSC system, what you're effectively spending as a contractor is future state earnings, all right? Because you're spending, the state has to pay for what you're spending out of their future share of production. And once the project's up and running, if you're continuing to spend capital on a project, as most projects do, it's not an all up front, you have some continuing trailing capital. Every bit of capital you spend along that way is effectively taking part of the state share out. So anywhere you work in a PSC system, the state very, very quickly becomes very incentivized to try and reduce anybody's expenditure. And it sets up a vast trail of auditing, expenditure, how the budgeting process works, lots and lots of fairly complex decision-making process. And those decision-making processes tend to slow a development down. For example, when we were running at Santos, a business in East Java in Indonesia in a PSC regime, we also had a similar business in Western Australia, which is a royalty tax system. If we had a smallish gas discovery near facilities, in WA, we could tie it in within 6 to 12 months, and Indonesia would be 3 to 4 years, because just the decision-making process going through government was that much slower, or through the PSC regulator was that much slower. And that is always the case in PSCs. It's very, very hard to do things quickly. And as time ticks on, investors basically losing money, losing rate of return, and so investors tend to not enjoy those sort of arrangements. Also, because of that, it means that the investor, if he's going to invest and he knows that things are going to be a lot slower, is going to have to get a bigger split. And remember, the investor's slightly handcuffed here in that he might want to invest in the country, but at the end of the day, it's not an emotive decision. It's purely a value decision on whether he can invest, get his money back, plus a certain level of profit, a rate of return that is acceptable to his shareholders and his bankers. And if you can't get that calculation to work, the investor just won't be there. So if you're going to go for a PSC regime, firstly, you've got to really be very, very careful to have it very well defined so that everyone understands what the playing field is. This hasn't yet happened in PNG. There's been no definition given of it. And then on top of that, the investor's going to need actually probably a bigger take than you would have had otherwise in a royalty tax system to get the same rate of return, which will just put pressure on the government take to start with, because you're basically making the profit pie smaller. In both these systems, whether it's royalty tax or whether it's a PSC system, you're not necessarily sharing revenue. You're actually really sharing profit. And this is a really important point that people need to make. In any system that you have, any investor coming in, the number one requirement is going to be using the revenue that is generated to get their investment back. And then they will move into a profit phase. And then the argument that we should be having here is how is that profit split between the state and the investor in a way that the state gets its fair returns and the landowners, obviously, in the case of PNG, do as well. So, look, I'm clearly an outsider to PNG. I've worked extensively in PNG as an exploration manager back in the early 2000s and more recently as Santos's representative on PNG LNG for since 2012. And, you know, it's not for me or for any outsider to tell PNG what their system should be. You've got to work that out and make it. But I've got a few comments on how your existing system does work. And it's clearly there are some issues with it, and these are things that we need to address, and forums like this are a very effective way of getting some voices with different opinions out there. But what the existing system is really quite clever at doing, and it's the only system I've ever seen in the world that does this, is that it gives the landowners through MRDC a representative actually on the main decision-making committees for any project. So I sit on the PNG LNG operating committee, with there's technical committees and financial committees and other committees as well. The principal committee is the operating committee. And we have a representative from Kumu on that committee, which is Waku Sonk, and we have Augustine Mano from MRDC and Andrew Barry from Exxon and so on from Oil Search and JX Nippon. So these are, it's an incredible system when you think about it. In other parts of the world, often landowners will get a royalty payment of some sort, but they're not part of the decision-making process. They're not part of that fabric of the actual project. So that's the structure you've got. It's unique, and it actually gives a voice for the landowners and from the state right into the main decision-making committees, which I think is really, really important. The other thing about the existing system, the Department of Petroleum and Energy administers it basically, and it is a relatively simple system to administer. Basically, the company will be spending money and it will get to a tax-paying position. It will then be audited and paying tax. Its activity is regulated by the DPE and the various environmental groups and other things. This system is well travelled, well understood in PNG, and it does work. What we have seen, so I just caution people, changing radically to another system and probably having two systems working in parallel will put a lot of stress on PNG going forward, and we need to really, as a group collective, investors and government understand whether that's really a great thing to be doing. I will acknowledge as well, I mean, it's commonly talked about, the tax take of projects has perhaps been disappointing, and royalty tax, obviously the royalties are going out. The equity benefits of Kumu and MRDC being in the project are definitely being received. A lot of these projects perhaps are disappointing in their tax take, and that's clearly a problem. I don't actually think in a PSC it'll make any difference though, because what you're talking about with the project not being a tax position means it's probably still depreciating the capital that's been spent in the royalty tax system, so it hasn't got to that profit phase and paying tax. In a PSC system, you'd have the same thing happening in that if you hadn't got to complete cost recovery, you would still be having the lion's share of the revenue will be going to the contractor, not to the state. And really, it won't make a whole lot of difference to you either way on government take. So I think the move to PSC, in summary, we've got to be very careful. It's not a panacea that's going to give us an instant fill up on government take somehow. We have a pie that's a certain size. It has to be split to pay off the investment and then a profit split between the investor and the state. We can engineer that through either system, but going to a PSC will bring in a lot of uncertainty, which will stall investment for a while. When it's established, it is less efficient than a royalty tax system and much harder to administer. And if you're not a regulator familiar with administering these, you'll probably find that companies that are more expert at working in these regimes will certainly be able to advantage themselves out of them. So I don't think it gives you an easy way to a bigger government take. It's a lot more complex, and I think it will just slow down investment into PNG, which will have a huge follow-on effect on the growth of the country. So in summary, the existing system is really good, but it needs tweaking, and we need to address some of those issues that the good minister raised at the previous webinar, particularly around how the state's funded and how long it takes to get state taxes being paid. But before we try and change anything too radically, we should really make sure we understand what it is we're changing and what we're leaving behind, and make sure we've defined something that is actually going to work. And at present, I don't think industry, mining or petroleum has seen how that is going to work. I'm also remain unconvinced quite whether landowners fit in a PSC system, but maybe some of the later speakers might be able to talk to that. So, Richard, I'll hand back to you. That's probably enough as a sort of introduction on PSCs.
Yeah, no, thank you very much, John, and appreciate that. And then this is a great time to bring you in on the discussion, Arthur. I think we're heavily involved in the PNG LNG. That was a mega project, well in excess of $19 billion US. And it had a large impact on the economy of Papua New Guinea, particularly during the construction phase. And there's no doubt it had a great effect on our GDP as well. And I know you appreciate Minister Kua's concern about this ratio, and I understand it was recently increased to 45%, the debt to GDP ratio. And so with that background, Arthur, could you just explain how we were able to bring along PNG LNG, and then just share some of your views in hindsight now, and what you would believe is good to move Papua New Guinea forward?
Thank you, Richard, and thank you for that question. I think I'll start off by saying that the existing system, if I could borrow John's segue into this, we have a predictable, a certain regime that gives us absolute clarity and certainty for external investors to invest in Papua New Guinea and appreciate that they will get a return on their investment at the phase of development of the project and when they actually move to production. And it's absolutely critical that Papua New Guinea continues to develop and strengthen existing laws that it has to woo that foreign and direct investment into Papua New Guinea. And that, I think, it is because of the existing legislation that allowed for people outside of Papua New Guinea, especially the investment community, to look at the resources that were available in PNG, to look at the credibility of the companies that had associated itself with the resource in the likes of ExxonMobil, Santos, Oil Search, Nippon Oil, and have certain confidence that they would want to develop a gas resource in PNG when PNG was previously only an oil-producing province. We had not quite arrived at the juncture where we were a gas producer. So in the gas space, it was PNG's first foray into trying to secure investment coming into PNG. But with the branding and the names of the corporate that were there and the certainty and clarity about the legislation, what the state take would be, what the corporate take would be, the corporates then were able to make an application to the government of Papua New Guinea and said, we'd like to move now on effectively 8 of our licenses, and we'd like to commercialize first gas within Papua New Guinea. So at that particular stage, the laws in Papua New Guinea enabled the corporate to then offer back to the state through a mechanism which is called the back-in option. And the back-in option today allows Kumul Petroleum Holdings to enjoy the benefit of early revenues since production has started from the PNG LNG project. So it is that particular certainty in legislation that allowed for the corporate then to offer that particular interest to the state. It was for the state then to say, how do I realize the value in that particular option? Well, there are tools that the state need to use. And those tools are the open book economic model that will be provided by the corporate, and also an information document called an information memorandum. Well prior to the project, the information memorandum basically gives the project description. So how many kilometers of pipe will you put down, how much resource is to be used, how much gas do you need to underpin the economics of the product, the project, the gas that would underpin the economics of the project. All of that was necessary information for government to have. And the project, together with the project owners, passed that information on to the state, the open book. So the open book allowed the state to see how its equity interest, how much its equity interest would return, and how you would finance the project as well. Important tools for the state to move forward. So the undertaking for the PNG LNG project after that decision that the corporates decided that they would move forward to commercialize first gas in PNG was for PNG now to say, okay, how do we finance that particular equity option that we have? Do we take the full 22.5%? And I think a common mistake that is made in PNG is people think that it's an aggregated 22.5% that you take. No, it's per every license. So PDL 1 offers 22.5, PDL 7 offers 22.5, PDL 8 offers 22.5, so on and so forth, PDL 9 the same. But those rights were already utilized or not utilized in the Kutubu project. So in the Kurupu project, they had already exercised those back-in rights, so the number doesn't go up to 22.5, it is actually 19.4 as a consequence of brownfields that had already worked those rights through. So you end up with a lower 19.4 as opposed to 22.5 if people thought that it was a whole 22.5. No, there are 4 brownfields, there are 4 greenfields. Only the greenfields rights were exercised. And if you aggregate those together amongst the 4 greenfields, it'll end up at 22.5. But if you couple that with the brownfield, obviously the average and the number goes down to 19.4%. I think that point just needs to be made, Richard, on this one, because it's been a matter of much contention over the years. With regards to that particular equity going forward, for the PNG LNG project, the project was project financed. So in other words, external financing was necessary for it to come on. Every single party, including ExxonMobil, who had, I think, 33%, Oil Search 29% in the project. I think Santos, John, correct me if I'm wrong, was around 14%, Nippon Oil about 5% in total. MRDC, together with all state entities, 19.4%. If you aggregate all that together, that ends up to about that 100% that we're talking about. It's the state needed to fund and the corporates needed to fund. There's 2 fundings that need to be sanctioned. The first financing is the financing of the equity, so your share in the project itself needs to be financed in the beginning. So in around 2008, Peter Graham, at the time, who was SO Highlands, asked myself and the state basically to show the color of your money. So as a consequence of that, what does the state do? Do we go into consolidated revenue and take the money out there? Or do we look at another financing way of financing our interest in the project? And obviously, the policy of government at the time was very, very clear. You will not go into consolidated revenue. You will not sell down on the equity. You will not pre-sell any product from the project. Find another mechanism by which you can finance the project. We, in the Independent Public Business Corporation, from the General Business Trust, had a particular asset, which was the All Search shares, 196.6 million shares that were trading on the Australian Stock Exchange at the time, I think around $4.70. So the state then, together with Treasury, decided that it would be feasible that we could leverage such an asset, find the appropriate financing mechanism to move forward to raise the necessary financing to find the equity interest in the project. The project itself, being the project owner, would finance the project financing side. So Exxon led that particular round. They had essentially 7 ECAs, export credit agencies from China, Japan, United States, Italy being SACE at the time, and Australia's own EFIC that also financed. So you had 7 ECAs and 21 commercial banks. I think for the PNG government utilized the All Search shares. It then structured its financing through what is called now the exchangeable bond and raised the necessary financing that was required to finance its equity interest in the project, and that was around 1.2 billion US dollars at that time to take up that 19.4% interest in the project. Now, I think the question of Richard talked about the debt to GDP ratio and the impacts of the project onto PNG. There is obviously two impacts. The first impact is the huge capital spend of 20 billion US dollars that would flow into the PNG economy. The job numbers that it would create, the multiplier that John talked about in the economy itself. So effectively what we did at that time, we also engaged in a study with Deakin University through Dr. Mark McGilvray to conduct a study to look at the impact of the early capital spend, and also to look at the back end, because PNG goes through these fantastic boom and bust cycles, to look at the back end of what the impact of a huge project would be. Would it create the Dutch disease in PNG? So a study was put together to look at that. So you looked at the issue of the impact on Forex, you looked at the issue of the impact on the labour force and the labour market and the availability of skilled labour set in PNG, the issue of infrastructure that PNG had available within PNG to take on such a project, and whether at the back end you'd get this fantastic cost escalation as a consequence of having too small a skill set in country, as opposed to having the skill set necessarily available, which would have kept the costs down. So at the front end of the project, you had this 20 billion spend. Now, the 20 billion spend that we saw in the PNG economy, I think we still enjoy some of that impact today. The infrastructure in Port Moresby and other parts of the country can certainly see that. That doesn't come from production money. That's not coming in from taxes at the moment. That's not coming in from revenue directly from Kumul. That is as a direct consequence of that foreign direct investment that rolled into PNG one day. And I think the backstory, Richard, associated with this is that in 2002, PNG had a drop-dead date for the Oktedi mine closure. So it was a do or die for PNG. It was about revenue certainty in the economy, and if we did not convert on the next big project, then where would the PNG economy be today? It's almost a question like today. If we do not convert on the next big project, where would PNG's economy go to?
Just on that point, Arthur, just if you don't mind, I just want to come back to in your time in the government, there was the oil shares that was able to be utilised by the government at that time. I think right now, Minister Kua is saying, perhaps without assets of that nature, do I need to go? So I just want to understand this. How else can we finance it in 2020 going forward? Because I think this is the issue whereby Minister and the government are saying, we don't want to go into debt, we don't want to increase our debt to equity ratio, we need to find a way to fund it, and in the mind of government, current government, production sharing contracts will give that opportunity. Can we just focus around that, please?
Certainly, and I think if we take a lethargic approach, we'll go down a particular path. But I think that like the oil search assets that sit under the General Business Trust, we today have a fantastic asset in the PNG LNG project that is actually into cash flows right now, that has fantastic cash flows. Many, I think over 500 ships have already left the shores of Papua New Guinea that generate revenue to the Kumul companies. So if we were to leverage the Kumul companies at this stage as we leveraged the General Business Trust and the Oil Search shares in 2007, 8 and 9, we would be able to finance our projects relatively easily. Any project, we would be able to finance the Papua LNG project, we would be able to finance the Wafi Gobo project, we'd be able to finance the Pinyang project.
But would that be off the state's balance sheet?
That would be revenue that comes in to one of state's entities. So yes, it is the opportunity cost is, does that revenue go into consolidated revenue right now, or does it just sit on the balance sheet of the Kumul companies? At the moment, it sits in the balance sheet of the Kumul companies. I think there have been some small dividend payments that go in, but state can certainly leverage that particular asset to be able to finance the next mega project and start to stimulate the PNG economy by attracting that foreign direct investment in.
Okay, we'll come back to the issue of Kumul Petroleum Holdings. I think that's an important discussion for the people of Papua New Guinea, where we talked of revenues coming into Kumul Petroleum, and then this issue of previous treasurers saying, I haven't received this money to consolidated revenue yet. I think if we can come back to that. I'm just going to bring in our next speaker, Arthur, and that is Vaughan Mills. And Vaughan, what I'd like you to just talk to us about is the organic law on the equity of minerals and hydrocarbons. You've heard from Arthur, and I think we can build that a little bit. So Vaughan, if I can just hand across to yourself, please.
Sure, thanks very much, Richard, and thanks for the opportunity to be involved in this webinar on such an important subject. I thought what I might do is first of all explain to our audience what exactly is an organic law. I'm sure a lot of people are wondering actually what this thing is, what this creature is, so maybe I'll explain a bit about that. Then talk about some of the provisions in our constitution that are relevant to this organic law. And then some of the legal uncertainty, I think, that this organic law or this proposed organic law might bring to the sector. So first, what's an organic law? So just to give everyone a PNG Law 101, if you like, there's a hierarchy of laws in Papua New Guinea, starting with the Constitution at the very top, then a level below that, although at a similar level of entrenchment are organic laws, and that's the proposed law that we're considering at the moment. Beneath organic laws are Acts of Parliament, they're ordinary Acts of Parliament, and then beneath them is the common law or underlying law as it's known in Papua New Guinea, which is essentially case law and the cases that come out of courts in Papua New Guinea and also other courts, English courts from the date of independence. So what's different about an organic law compared with a constitution or an ordinary act of parliament? Well, an organic law is not quite as, is not superior to the constitution. So the constitution is superior over any organic law. So organic laws need to be consistent with the constitution. They can't do things that the constitution doesn't allow them to do. And constitutional law, the constitution and organic laws are entrenched in the sense that to change them or to make them requires extra things to be done, extra sittings of parliament, longer time periods, longer notice periods, higher majorities to pass them in the parliament, as opposed to an ordinary act of parliament, which ordinarily would be passed by just a majority in the Parliament without any special notices or periods of time to consider. So hopefully that gives people a bit of an understanding of what an organic law is and what this particular piece of proposed law is about. There's a couple of provisions in the Constitution itself that are relevant to this organic law, and I want to mention them just very, very quickly. First of all, Section 212B, which is a relatively short provision, but it's the provision in the Constitution that gives the Parliament an ability to make an organic law about minerals. And it says that it confirms the state owns all resources in their natural state within Papua New Guinea. And then it goes on to say that an organic law may make further provision in relation to those minerals and the state's interest in those minerals. So that's the power under which this organic law is made. There's also another provision in the Constitution that's quite relevant here, and that's subsection 3 of Section 100. It says that nothing in a constitutional law, so that's the Constitution and organic laws, nothing in them may enable the Parliament to divest itself of legislative power. So that's quite an important provision, which I'll come back to in a moment. It's quite relevant to our proposed organic law that we're considering here. Another relevant provision, Section 53, which is about not compulsorily acquiring property without compensation. Again, I'll come back to that in a moment. So why is Section 212 and Section 100, subsection 3, important to us here? One of the features of the organic law is to essentially confer all regulatory power in relation to minerals and the state's interest in minerals into either the MRA, which currently exists, or the proposed new National Petroleum Authority. And what the proposed organic law says in its own words is that that regulatory power is ceded, or it's ceded irrevocably by the state to those entities. So perhaps you can see that there may be an issue there with this regulatory power, which is essentially a legislative power, being shifted entirely into the MRA, or the National Petroleum Authority, and whether that is consistent with those provisions of the organic law I've mentioned. Because it goes, at least I think there's a question about whether the organic law goes beyond making further provision for the state's interest in minerals, to completely giving that power away to other entities. So look, I think that's an important thing, I think, for the government to consider and the Parliament to consider in terms of the certainty of these provisions as and when they go further through the parliamentary process. The other provision that I mentioned is Section 53, which is a very important provision in Papua New Guinea's constitution. It prevents the state from compulsorily acquiring any property of a citizen of Papua New Guinea, other than in accordance with an act of the Parliament or an organic law. And then it's got to be for a public purpose where it's reasonably justifiable in a society like Papua New Guinea, and there needs to be just compensation paid on just terms. Now, the proposed organic law has all of the opening words around it, around if there's a compulsory acquisition of property, that it's for a public purpose and there's going to be just compensation and so forth. But there's actually no detail about that at all in the organic law. So for me, it raises a question about whether there's adequate provision in this organic law around these issues. And it's particularly relevant to landowners and surface rights, because the organic law doesn't deal at all, the draft organic law doesn't deal at all with surface rights. And that's to be compared with the current law in the Oil and Gas Act, or the Mining Act, and indeed in the Environment Act in relation to hydropower projects, or indeed the Land Act, where there's the compulsory acquisition processes generally available to the state to acquire land for public purpose. All of those provisions all of those laws have quite detailed provisions around the process for compulsory acquisition, the compensation that needs to be paid, the basis on which it's payable, and so on and so forth. And they're all now well known, well tested provisions that have stood the stood the test of time. What we seem to have in the organic law is a shift away to all of that regulation being shifted onto a decision-making body such as the MRA or the NPA, and then ultimately to the Kumul nominee as and when it takes ownership of a particular project. I think coming back to some of the points that John Chambers made and Arthur made around the need for certainty in natural resources projects. These projects, I think, as we all know, are very, very complex technically and commercially, and of course also legally. And I think what Papua New Guinea has at the moment is a very well-developed, well-considered, robust regime for the development of resources projects, whether it's oil and gas, whether it's mining, whether it's hydropower, whether it's forests and so forth. And it deals with all of those really important things that the Constitution requires us to deal with around how taxes are imposed, how we deal with acquisition of property, how we compensate people who are affected by the projects. What the organic law, the draft organic law, seems to do is do away with a lot of that existing infrastructure. And coming back to the point I made earlier about the organic law ceding irrevocably all regulatory power in relation to the state's interests in resources and in mining and oil and gas, it's really not clear at all what is the extent of this ceding of power. So if it is effective and it doesn't offend the constitutional provisions, it begs the question: well, how broad is this? How broad is this conferral of power on these regulatory bodies? Does it include, for example, power in relation to environmental permitting? Does it include power in relation to taxation? Does it include power in relation to granting of surface rights and therefore compulsorily acquiring rights from landowners? So I think, look, they're all open questions, and there's no detail at all about any of those matters in the draft organic law. And so when you're coming to permitting and financing these major projects, which are difficult enough as they are, and extremely complex already, and already carry large amounts of risk, it seems to me that quite a significant legal issue in the draft organic law is moving from what is relatively certain system to a quite uncertain system, because there are at the moment so many gaps, and it will only make it more difficult, I think, for projects to get to the stage of being permitted. So, Richard, I might break there, and maybe if people have questions, we can come back to them later.
Thank you very much, Vaughan. I do want to come back to that aspect again, but I'm going to, we've got a few questions coming in, and I think one of them, John, I'm going to come back to you and then pull you in, Arthur. Just also at this point, Philip Somare has dropped out. He was dialing in, and I'll get an indication when he's back on air again, because we do want to talk about the mining side as well. But John, in some of this, in a lot of the public discourse at the moment, and the people of Papua New Guinea are saying that why it sounds illogical that the state has to participate upfront in the sunk cost in the exploration at decision time. So why can we just speak about that, John, about how else can Papua New Guinea get engaged in this? I'm aware that when a company comes in on either the mining or the petroleum side, there is the exploration side, then you go on, in our business, the retention side, as you develop and try to understand what is under the ground and how one's going to develop that. And that could take 20 to 30 years, John, which is a large cost. But for the people of our country, they're saying, yes, but we own this anyway. Why do we have to pay? Can you just expand on that and probably draw on some of your international experience on that aspect, John?
Yeah, Richard, that's a good question and stuff. And actually, I've been looking at some of the questions that have been coming in while other speakers have been making their points as well. And one of the things I'll just address before that, because it was a question that was while Arthur was speaking, you know, there's one of the people in the audience asked, you know, what did PNG LNG actually spend in country? And so just to give you a few stats on that, there was 11 billion kina spent in PNG for PNG LNG, of which 3 billion kina was spent with local land codes, and returns to the PNG government to date more than 10 billion kina, and that's, you know, we'd all love that to have been more, but we've had periods of low oil price post 2014 when it started up. We've had a major earthquake in 2018 that interfered with production, and again low prices. So anyway, hopefully that answers the question of one of our audience members earlier that was on the that I know is coming up on the screen there. But anyway, getting on to your question, Richard, which is actually a really good question, and I think it's something that people feel quite passionate about in PNG, because it's been portrayed as if that that somehow the government, when it licenses acreage in the royalty tax system, effectively gives everything to the investor, and the state loses control, and then the state has to buy that back to get into a project, and then pay to participate, and that doesn't sound right. And of course, it's not right, because that's not actually how it works. And I think after this, maybe Vaughan can go on a little bit more about ownership and transfer of ownership and how that really works. But what I would say about it is that I'll just give you a bit of an explanation of how this works, whether it's in a royalty tax system or a PSC system. In both systems, when the government wants to get some activity and exploration and gets people, that means people going out to find a resource, whether it's minerals or petroleum, in both systems, the investor will go out and they'll shoot seismic or do surveys and drill wells or drill mining holes, whatever it is that they do. And they'll spend millions, tens of millions, in our case in petroleum, hundreds of millions, if not billions of dollars on doing that. And so that's money that's been sunk a long time before production. For example, Hides, which is the backbone of PNG LNG, was discovered in 1982, came on stream a little bit in the late 90s for the local power project, but mostly for PNG LNG, effectively came on stream really in 2014. So big gaps in oil and gas, and also in mining, between the exploration spend and the mining spend. If you want people to actually invest in exploration, find resources in your country to help you develop it, you've got to take into account those long timeframes and the amount of money that people have spent. So in a PSC regime, that cost that you've spent there will go into the cost recovery pool, and when production starts, you will pay that back. So there's no free lunch in a PSC system. You still pay for that sunk exploration cost. In the royalty tax system, the difference is you pay for it, but you pay for it when project is sanctioned, just when development starts. In both cases, you don't pay for unsuccessful exploration. So you're paying for you're paying your sunk cost of the successful exploration in that permit for that project. So both of them are very similar. Again, it gets back to what I said at the in my opening answer. Is it's all about the mechanism of funding it. The PSC, you pay for it out of production in later years, so less revenue in later years. In the royalty tax system, you pay it up front as part of when you enter it. The beauty of the royalty tax system and what you've managed to do in Papua New Guinea, back in the Gdp project in the 90s, and more recently in the Papua project, you've managed to actually say, well, the state's not really very happy about paying those costs. So basically, what you can do is you can reach an agreement to pay those costs out of production in years to come. So the same mechanism that the PSC's got has been and can be built into the existing royalty tax system just through negotiations when you construct your gas agreement or your oil agreement, or presumably your mining agreement. So you don't really need to go this whole hog into the PSC thing. You can actually do that, solve that problem within your scheme. It doesn't actually matter which scheme you go to, you're always going to have to pay back those exploration costs, because that's just the nature of investment. So there's no panacea here, as I said before. The PSC system doesn't stop you paying those costs. You just pay them out of production later. The royalty tax system, you pay them. but we can potentially, industries open to having those deferred and paid out of production as well. So, I think it's a bit of it's an emotive issue, obviously. It's been characterised that the state has to pay to get back into its own resources. I don't actually think that's really valid, but maybe if I hand back to Vaughan now, Vaughan can maybe explain how custody transfer occurs in the various schemes, and that might be something that people will be interested in.
Yeah, thanks, John. Look, it's a really interesting issue, and I must say I've been a little perplexed at. I think one of the great advantages of the PSC regime has been said to be that title sort of remains with the state through the process. Under the current law, it's slightly different for mining and oil and gas. In mining, the Mining Act says that title, sort of once the miner mines the resources, it becomes entitled and owns them, and then can sell them. Then in oil and gas, it is slightly different, where the developer has a right to sell the petroleum that's recovered and produced. And ordinarily, there's a provision in a gas agreement or a petroleum agreement that determines the time at which title passes to the developer. So in petroleum, the question of when title passes is generally a matter determined by agreement between the state and the developer. You don't need legislation or a completely different regime to actually deal with that particular point. And then in the mining context, it would be a relatively small change to the Mining Act to alter that act to a similar regime where it is by agreement between the state and the developer as to when title transfers. I suppose what's important in terms of title and ownership of the resource from a project efficacy, from a legal standpoint anyway, and I suppose also a commercial standpoint, is that when the product is sold, when it's exported, when it's sold to buyers, buyers want to know that they get title, and lenders want to know that if their securities, if they want to call their securities as a default, that they are able to get access to the resource so that they can enter into possession and sell the resource to be able to recover their debt. All of those things, it seemed to me, that they're very properly and appropriately dealt with under the current regime, and I think it can be accommodated equally under a PSC regime. But I'm not sure that you need to move to a PSC regime to cover this particular issue of the state retaining ownership. All of the same issues will in terms of giving security to lenders, transferring title to buyers, will be exactly the same under either system, and to the extent that it's perceived that there needs to be a tweak to the current system for the state to retain title all the way through to the value chain, at least until the passage of title to the end buyer. I think that's actually very easily dealt with without having to completely readjust the system.
One of the key things is, on the subject of equity, like the current system in both the mining and petroleum, landowners and provincial governments and local level governments are well recognised and catered for, articulated in both pieces of legislation. At this stage, the organic law doesn't give us any indication on that. Can you expand if are they right out of the picture, or do they have to negotiate with, in the case of petroleum, Kumul Petroleum, with Kumul Mining? Is that how you read it at this stage? Albeit we haven't got the full legislation yet.
Richard, it's a really good question, because I think, frankly, the answer is we just don't know. There's no detail at all. What we do know is, as I've said earlier, there's purportedly a complete ceding of regulatory power to regulatory authorities, and then later, when Kumul exercises its rights to come into a project to the Kumul nominee. So I think all we can presume at the moment is that, given that complete transfer of regulatory control and management and authority to those entities, they'll be the ones that deal with those issues. I think you rightly point out that whereas under the current regime, and again, it's a little different from mining and oil and gas, but under the current regime, there's a clear articulation of landowners getting a particular percentage of equity and also royalty, and that's quite clearly articulated and defined. Everyone knows what it is. Landowners have an opportunity to participate in the project. As John has pointed out earlier, they get on the operating and management committees and so forth. And also there's a very, very clear regime for how landowners are compensated in addition to royalty and equity benefits for the displacement that they suffer from their land because of the development. We seem to be moving to a system where none of that is articulated at all. And while there may be further detail to come in further legislation, it's not clear that we will get any detail at all, because, as I've said, the organic law seems to suggest that all of this decision-making and all of this power and all of the regulation of these matters is to be dealt with by either the Mineral Resources Authority or the National Petroleum Authority, and then later the Kumul entities.
Yeah, and that's important, Arthur. I'm not sure if you're hearing anything in the political space on that fundamental, because under the existing laws, as the existing laws cover equity, cover surface damage, as we talked about earlier. There's a wide range. We articulate social mapping, landowner identification, how we develop that. That's not clear right now. And then at the same time, both John and Vaughan have spoken about it be Kumul Petroleum or Kumul Mining. Under the existing law, Kumul Petroleum, which is receiving revenues and profits from projects, are they accountable under the Public Finance Management Act and therefore accountable to the Parliamentary Accounts Committee? How's that? Can you just elaborate for our audience about what you understand for Kumul Petroleum now, and how can we get more transparency?
And perhaps it goes back to the issue of the genesis of financing for PNG LNG as a consequence of how we need to structure the financing moving forward, because one of our bigger lenders was obviously the World Bank, ADB. There was an issue of negative pledge that became a significant matter for the team working on the financing for the state. So effectively we had to quarantine some of those issues associated with the negative pledge to a mechanism that was created where an SPV could then carry the equity.
That's a special purpose vehicle.
It's okay. A special purpose vehicle where that liability was not seen directly on the balance sheet of government, so it was an off-balance sheet transaction. As a consequence of that, some may argue that, well, you've given more independence to Kumul. No, the issue is the initial benefit or the initial asset that was utilized came out of the General Business Trust, and that was the Oil Search asset.
Was that in Petroleum? Before the creation of Kumul?
No, it was
it Proton?
The General Business Trust that held the Oil Search assets has one shareholder, and that is the government of Papua New Guinea. The people of Papua New Guinea own that particular asset. So that particular asset was completely leveraged to finance Kumul's entry. It is therefore reasonable that Kumul be absolutely accountable to the Public Accounts Committee, be absolutely available for scrutiny under the Auditor General's office and be absolutely accountable to the Ombudsman Commission as well, because the asset always belonged to the people of Papua New Guinea, the initial asset that was used.
But Sir John Pundari, in his capacity as chairman of PAC, found that he had no, the Public Accounts Committee had no authority or jurisdiction to inquire into Kumul Petroleum Holdings.
I hear what you say. I'm going back to the genesis of where of how the financing of that equity came out from in trust law, and I think lawyers would be better would be more familiar with this. If an asset is taken out from the general business trust, fair compensation must be returned into there. Now, I think laws were developed that basically extinguish that as an obligation, but it is my belief that that should have never happened.
Right. So, because a couple of months ago, Kumul paid 200 million kina to the state, but there is this thought that Kumul continue to enjoy and are holding large dividend payments from PNG LNG, which is a small, and what they're giving to government is a small percentage. I do know in conversations with the previous treasurer that he was concerned and not happy that he wasn't getting any monies from Kumul Petroleum into consolidated revenue. And I thought that was relatively simple for government to fix, but it doesn't seem to be. So how does more come out of a consolidated revenue into, come out of an entity like Kumul Petroleum or an entity like Kumul Mining to come into that? Because the discourse now is we're not, Miplano Kakailong, PNG LNG, Miplano Kakailong on the gold projects. And there is a perception that changing the organic law will be able to feast more. Can we clarify that to our people, Arthur?
Yeah, no, absolutely. I think that the production started, I think the first cargo left PNG on the 31st of May, 2014. The state has a total of 19.4% in PNG LNG, 2%. 2.78% of that belonged to the people of Hela and Southern Highlands, all the PDL license owners. The residual that's left over, which is 16.38%, goes directly to Kumul. Kumul is not the operator. The operator will deduct its cost, and there may be cash calls, continued cash calls by the project at a certain point in time, but there should be revenue coming out from production. This is quite distinct from the anticipation of the state generating taxes, and that would become the function of obviously the open book economic models and the financial models that are available to Treasury, so they can assess potentially when the first tax would roll in. John can comment about that, but right now Kumul enjoys the benefit and the benefit of getting monies in to the companies from the proceeds of sale, and they've had over 500 ships that have already left. So the benefits of the proceeds of sale should equate to, I think, 16.38% of sales proceeds.
So would that be, say, for the ordinary man in the street, are we talking 5 billion, 6 billion kina of that that may have transited through Kumul since first cargo?
I think the owners are better. John would be in a better position to talk about that, but I would suggest that the numbers would be about as high as in the 5 billion mark. Kina.
So John, pick up that hospital pass as a partner of PNG LNG, because.
Sorry, let's get off mute there. Richard, I can probably answer that one. 5.6 billion kina has come to Kumul since the project started production in May 2014, as Arthur points out. So that money definitely flows. But Kumul has other investments and things that it does, and it probably also has to prepare for expansion projects because, as Arthur has pointed out, it doesn't need to go back. It doesn't want to go back, perhaps, to consolidated revenue as a source of funding. But so Kumul runs itself very much as a independent company, which I think was always the vision of Kumul Petroleum as a state oil company, which is an admirable vision. Maybe in a later webinar we can get them to explain that. I'm sure at some of our earlier conferences we've heard the former chairman of Kumul talk to how it's structured and how it works. But it's certainly, in our view, and this is perhaps one of the pieces that has clouded the debate a little bit in PNG. A lot of external analysts and big groups that should know better don't count the Kumul take as government or state take. It's our view very much in the investing community that is state take, and that 5.8 billion kina or 5.6 billion kina that's come into Kumul over the recent years of the project is actually state take. Now, the state has its options of what it does, whether it leaves some in Kumul, whether it all goes to consolidated revenue, however it does. And as Arthur says, the people of PNG, through that one shareholding, own Kumul entirely. So that is, in our view, state take. Now, and that's where a lot of the misinformation has been given on PNG when they look at the take and they just look at the purely taxation take and the royalty take. They don't look at that Kumul take. They get a very low figure. And a lot of the politicians in PNG have been misinformed that their system is actually not particularly good and not effective in terms of state take, but it's low. But when you actually consider that the Kumul is state take and you build your calculations and your evaluations around that, you'll see that the state take in PNG is very, very close to 50% as it stands at the moment, which is pretty competitive by world standards. In Australia, for example, the state takes around.
Sorry, John, 50% of what? Sorry, 50%
of the profits. Of the actual take of the profit, basically, yeah.
Based on the shipments of cargo going out.
Yeah. So at the moment, well, the cargo, as Arthur said, there's operating costs and other things to be paid off as well. But of the money that's been is being liberated to the project, ultimately, once taxation and everything cuts in over the life of the project, it'll be very, very close to 50% state take in PNG.
Okay, so
for PNG LNG.
So back to this concern about the lack of taxation. Just explain for the audience, PNG LNG's financing will be paid up or retired depending on the price of oil and gas, but it's estimated, is it 2025, 2026 at this point? And after that, large taxation revenue will fall to Papua New Guinea, in addition to what Kumul are getting at this point in time. Are you able to just expand on that, please, John?
Yeah, okay. It's a bit of a complex thing, and I'm not an accountant or a tax accountant by any means. In 2018, when I showed the presentation at the Chamber Conference, which I think is available on the website, I hope it still is, we could see that under the oil price scenarios that were modelled back at project sanction time of around $70 a barrel or whatever, we'd have expected 4 years or so after production started to begin to pay tax on PNG LNG. And basically what happens is the capital, that $20 billion that Arthur referred to, that's on your books and you're depreciating that. That's in the royalty tax system, the mechanism of how you effectively get that money back. So you don't really pay tax because your income isn't large enough, particularly in times of low oil prices. Had we had high oil prices, we would have been in PNG LNG paying tax probably as early as year 4 after production. But with the lower oil prices we've had, the extra spend due to the earthquake, and the taxation payment time has moved to the right a fair bit. We're still in the process of depreciating a lot of that $20 billion, but we're beginning to get to the point where our actual profits are proper profits, and various companies will start paying tax. Now, each of the joint venture partners will be in a slightly different tax-paying position due to for historical reasons, but that tax payment will start coming throughout the 2020s. So that's what I alluded to at the start when I said that when we look at 2017, we see that the resource industry as a whole, that's mining and petroleum, was paying about 20% of direct government take. If you assume the prices as they are about present day, we will be going, PNG LNG will become a significant taxpayer throughout the 2020s, and you'll be getting up to 30% of direct government take will be coming out of the resource industry, just neutral of other projects. So there is still a lot of growth in taxation take to come. And the back half of these projects, whether they're in Australia or they're in Papua New Guinea, is where the government tax take really comes. Now, in PNG, you've obviously been aware of that. That's why you've got this Kumu equity that gives you this equity take up front that gives you early cash flow. Now, interestingly, in Australia, they don't do that. So the only taxation take you get in Australia is this government tax and some royalties up front. So the PNG system is certainly a lot more favourable to a state than the Australian system, because it's giving you that Kumu share up front. But I mean, I think everybody will agree the taxation story has been a little bit disappointing. But that's actually a reflection that overall the project's been a bit disappointing, not on the engineering, construction and the fantastic achievements, but the prices have actually been lower than perhaps we anticipated back in 2009 on sanction. And therefore, our profitability as investors has been less, and that's reflected in the state's taxation take has been deferred a bit to the right. It's as simple as that. But because these projects have got, they go for 30 or 40 years, you know, you've got to really be looking at it on life of project. And something like PNG LNG, although it's been a bit disappointing on tax take up front, over life of project, this is going to be a fantastic steady revenue source for PNG. Albeit, as the prices go up and down throughout the years, you'll get fluctuations in the actual earnings that the state sees through tax take. But you're also going to always be getting that approximately 20% take that's coming out of the Kumu MRDC share, which is in our mind government take.
Yeah, and I think that's very important for our audience to appreciate. We are earning money via Kumu Petroleum. We're earning money via MRDC. Yes, I think the industry needs to acknowledge the issue with taxation, but that's not about the industry or not its business. But over we need to look at the perspective, and Arthur, this is what the wisdom of the government at your time looked at, that 40-year life of the project, and that's what's important. And I think one of the issues is where we have a life cycle, Arthur, of 5-year life cycles of members of parliament. There is this couple of things. One is perhaps the lack of appreciation, lack of background of how we brought those projects to sanction and construction and production, and then the innate nature of politics that I need to deliver something during my term and my 5-year term, and it brings us a shorter perspective and perhaps impatience at this point in time. So what's important is for a state to look at multiple projects coming in or a flow of projects, and I think that was what the previous government's view was, that we had PNG LNG, that Arthur was a greenfield project apart from some of the oil, and then it was a foundation project. And I think Papua is come along, Pyongyang is there, Papua is still, there needs a few things to be sorted out in Papua. But as a government, do you expect the government to improve its, I don't like the word take, but have an improved position based on experience now that we've had a major project like PNG LNG, we've got Papua, we've got Pyongyang to come along. In the mining side, we're a very experienced mining country, and I guess the state we have a lot more experience in mining, and there's a expectation that we need to improve for Papua New Guinea. If you could just expand on that, and in a measured way, how should we be looking at this as political leaders?
Yeah, thank you, Richard. I think with any new project, and especially a foundation project, a first mover project, there will be concessions that government will necessarily consider on the fiscal term sheets as we negotiate a fiscal term sheet. But with a second project that comes on, obviously the markers are already in the sand. You can only improve from the last project. The state also has to consider the issue of aggregation. So what you're basically doing is you're aggregating on each project value. So there's a value proposition on each project. There is a benefit that the state will receive vis-a-vis taxes, vis-a-vis landowners through royalty, and as their participation in equity. That increases from one project to the next project, and as you aggregate it, the pie becomes bigger, and the PNG economy as well enjoys that benefit. So to answer your question, should there be an increment? Yes, there's an expectation that the foundation project may have given certain concessions, and as John has stated, if there's an economic benefit split of 50-50 on the first one, you expect that there will be an increment, not too high where you would scare that foreign direct investment away from the shores of Papua New Guinea, because Papua New Guinea is not the only country in the world that offers oil, gas. There are other competitive regimes that are out there, and we compete in that sort of environment. We've got to have a regime that is predictable, that is certain, that is stable, a judicial system that is also that supports contract and contract law, that allows us to bring that investment in. And I think political leadership in our country should work very hard to woo and secure that type of investment to assist in growth in the economy.
Okay, and I think we in the last half hour we have, and this is to all the panel, the government has a slogan, there is a desire, there's a very strong sense of nationalism and patriotism. And what I'm hearing from the panel today so far is that we have existing laws. We need to, I think, and let me just put my Vice President's hat on of the Chamber. What I'd like to make clear at this juncture is that the Chamber is not against the state reviewing and reforming its laws. I want to make it categoric that the Chamber understands and appreciates that it's a prerogative of the state at any time to review its laws, including the laws in the extractives, the mining and petroleum. And the Chamber has been very consistent in this position. In fact, we've been discussing changes to the Mining Act and Petroleum Act, Taxation Act, Environment Act. These have been going on for over a decade. So the Chamber has always called on and demanded, in fact, engagement and participation so that we can have a situation where we have a better understanding. And I think when Vaughan spoke, Vaughan, you talked about some important structural changes, such as to an organic law. What's perhaps important now for the state is to perhaps pause rushing these organic laws through Parliament, and then developing, and I'm going to open this up, developing a white paper on this. I think we understand the state has, and the Prime Minister announced a policy position in his statement to Parliament last Thursday. And he talked about the things that Minister Kua spoke about as well. this issue of how do we finance our investments in the extractives without adding to this debt to GDP ratio. How do we get more out of our projects? How do we as a country and we as a people participate more? The Prime Minister in this policy statement also talked about the infrastructure tax credits, John, and I think that's perhaps there's a lot of misunderstanding on how that works. Prime Minister was right. When you talk about an infrastructure project, and they've been used for a number of very important infrastructure in the country, he's right in that it was taxpayers that paid for the football stadium in Boroko. It was the taxpayers that paid for the infrastructure around APEC. And the Prime Minister is not incorrect in that statement. We need to be able to explain to our people a little bit more about that, so there's this general understanding, including amongst members of Parliament and political parties, non-parliamentary wing as well, Arthur, so that we can come to a really good decision. And I think one of the big issues I see where we're at now is a lot of that uncertainty, because with due respect, the Minister Kaur has come out and he has, through a gazettal, described his law, and he's indeed given notice to Parliament last week of the organic law on ownership of minerals and hydrocarbons, but without a white paper which gives a little bit more information and structure. This is causing this lot of confusion. And John and Vaughan, in this time, the consequence is that investors are very concerned about this lack of certainty, don't understand about, okay, do we hold these projects? Do we put the handbrake on projects? And do we hold until we understand what the organic law is going to look like and what under the organic law, the new mining legislation and the new petroleum legislation is going to look like? We understand from Kaur's statements in that the equity will pass to Kumul mining and petroleum. That's what we've heard in the discourse. But underneath that is what's causing a lot of uncertainty. Yeah, so Arthur, as a politician, is the process that government gives a former politician, has a white paper on an initiative like this, and where does it articulate that proposed structure and the consequential thing? Because in this uncertainty, nobody will invest until we see the end legislation. How can we help the government with this in terms of a process?
Thank you, Richard. And John, before you jump in and before Vaughan jumps in, I'll take the opportunity, since Richard's already offended me by calling me a politician. I'm a former politician. I think the core issue for government at this stage, when it comes to stakeholders, obviously one stakeholder in any license that is issued in PNG, you have multiple stakeholders. You have the state, who is a stakeholder. You have state entities that are stakeholders. You have obviously the corporate, who is the stakeholder. But there is an important stakeholder, and that stakeholder is the landowner. I think John mentioned already, and I think both John and Vaughan mentioned the issue of landowners. The landowners, by virtue of the fact that they will continue to own the land at the date of the expiration of any license, the land does not transfer back to the state. The land stays with the landowner. At the start of a mining development project under current legislation necessitates that a development forum is called for, where the views and a consultation process takes place, where the state, together with the corporate, will hear the views of the landowners through this all-important concept of the free, prior, informed consent that is necessary for the project to secure and the government to secure. It's its social license to operate on land that does not belong to the state, that belongs to traditional and customary landowners of PNG. That consultation process is absolutely critical, because the landowner itself, through this type of consultation process, would be able to then enter into an agreement which is an enduring agreement that will stand the test of time and will not necessarily be challenged because they have been consulted first as to the issue of access onto their land, the displacement of the people from that land, and for want of a better word, to occupy that land for the mining period or the petroleum period. And for access onto that, there must be fair and reasonable compensation that, or a benefit that must be accepted by the landowner and must be offered by the state. Under the existing legislation, the regime is relatively clear. A royalty rate of 2% is given to the landowners. Under the existing regime, it is also relatively clear that the landowner also becomes not only a landowner, but he becomes a commercial owner, in that 2% equity is then given to them.
That's 2 and 2.
That's 2 and 2. So 2% royalty, 2% equity in any new petroleum development license as it goes forward. I think in mining it may be 5%, but I could be corrected. And I think Vaughan can correct me if I'm wrong on that one. But there is the issue of royalty that is given to the landowners for the issue of access, that access to the use of their land. And there are also significant other agreements, such as under the mineral legislation, you need a compensation agreement to be signed off first before corporate, the state, or otherwise can enter onto your land. You also need a resettlement agreement to be signed off first. Those two agreements become the pillars that support a mining development contract to sit on, because
and who owns, just on that, the doctrine, who owns the minerals or the gas or petroleum? The state owns that, or the landowners?
Well,
for the purpose of this discussion, just expand.
Well, very clearly, the state owns the minerals, owns the hydrocarbon. But for the state to extract, it must access land which is indigenous and tribal. It must access traditional and customary land. And for you to access and occupy for a period of time, there must be fair and just compensation.
Right. Yeah. So Vaughan, you want to just pick that up, because that you know, in the public discourse, we're talking about equity, we're talking about ownership. Can you just expand on the law of Papua New Guinea and just take on from what Arthur just mentioned?
Certainly. Can I start by saying I think Arthur has given us a very clear and correct explanation of the situation. I might slightly correct Arthur in one sense, and that is to say that landowners never give up their ownership of the land. Presently, an oil and gas tenement or a mining tenement merely confers on the holder of the tenement rights to go onto the land, to exploit the resources there, and then impose obligations to clean up and remediate before the developer leaves. The land always remains owned by the landowners. They're compensated for the loss of their use of the land from being displaced from the land, and in addition, as Arthur's explained, there are royalties and equity, and they become commercial owners in the project as an incident of being landowners in the area where the project is being developed. Arthur talked about the differences in mining and oil and gas. The various interests are prescribed differently. They arise in slightly different ways, but and the amounts of them are slightly different. So in the mining context, generally the state's equity percentage is 30%, and there's a bit more negotiation with landowners as to what the landowner proportion of that equity is and how much the state funds. But I think, just to reiterate the point, and I think Arthur's made this point, that the present situation is very, very clear. There are rules, there are well-known rules. The landowners understand the rules, the state understands the rules, the developers understand the rules, and they work with the rules to get to an outcome. I can't imagine understanding, as I do perhaps more intimately than most, the complexity of PNG LNG. I can't imagine an alternative legal system, particularly a PSC system, where you could achieve that same outcome negotiating with however many thousands of landowners. I mean, just the landowner representatives numbered in the thousands at the development forum. So I just think that shifting to a new system in a hastily really brings great uncertainty to the development of future projects, whether it's in 5 years or 10 years or 20 years, just because there's no tested road, I suppose, to how you get to these very, very complex outcomes. And I think if the rules all get changed, people, or indeed if the rules aren't there at all, there's no clarity on the rules, and at the moment there isn't any clarity on what the rules might be going forward, then I think it just makes it extremely difficult to build a robust legal structure around a project, particularly from a landowner standpoint.
Thank you, Vaughan. And I'm going to go to you, John, in terms of how developers would look during this period of uncertainty. And then, Arthur, I'll pass to you to give some concluding remarks on, and if we could be so bold as to advise the government on, what would next steps be if we were able to sit down with Minister Kua and Prime Minister Marape. Hypothetically, what key points would we raise with them with obviously utmost respect? John, just from a developer's perspective, as we come to conclude this, give us some concluding remarks on, we've talked production versus the current regime. What are developers looking at whilst they hold a foot on the brake and watch this play out in Papua New Guinea?
Okay, yeah, Richard, thanks for that. And just a quick one to follow on, because we were just talking about landowners and stuff, which I think we all recognise is an incredibly important part of the stakeholder framework in PNG. I mentioned before the project would have paid 5.6 billion kina into Kumul accounts, but it would have also been 1 billion kina into MRDC accounts. And that's to date. And if you look at the tax to date on PNG LNG, it's about 1.4 billion kina, which is probably a bit low to our expectations, but nevertheless will rise, as I mentioned before. And in 2019, the project would have returned 2.2 billion, or has returned 2.2 billion kina to the government of PNG, which is a pretty big amount of revenue. It would have been about 5.5 billion kina if we'd had the oil prices up at $100 a barrel. And once we pay the loans off,
sorry, John, was that in 2019 financial year? Sorry, John, was that in the 2019 financial year? Okay.
That's the 2019 financial year, yeah. Once we paid the loans off per year, the project, at about $75 a barrel, the project will be spitting out around about 7.5 billion kina a year to government. And by government, I mean royalties plus equity share to Kumul plus the tax that we've been paid at the time. The big sort of thing that I think people need to be aware of, there is no tax holiday on PNG LNG. It just isn't true. That's not reality. PNG LNG is depreciating its capital, will eventually be paying tax. There's no tax holiday on that project. So I think that's one of those statements we hear far too much about. But getting back to the discourse on the PSCs and things, and I think we talked a little bit earlier on about the complexity of PSCs, administering them. They are very difficult to administer. But what we haven't seen as an industry perhaps is if the government has a model PSC that they've formulated, and I'm assuming they must have a model PSC somewhere, what I would expect to happen is you'd run through your existing projects, whether it's Kutubu or PNG LNG or similar ones on the mining side, you'd run that through that economic model. And then you'd be able to say, okay, based on our model PSC, if we did PNG LNG again or Kutubu again or whatever it was, this is how the government take would look, and this is how the investment take would look. And if you did that, and you might have bigger government take, I would almost bank on it, you'd probably have smaller government take in reality. But if you did, well, then you'd have, if you did have bigger government take, the pie is split, it would be smaller investor take. Then the onus would be to have a look at that investor take as a rate of return and see whether anybody would actually invest in that regime. Now, what I think is happening at the moment in PNG, there's a proposal to move to a new regime. Nobody has actually tested that regime against existing projects or against future projects. So we don't know whether what is being proposed by the Minister is actually an improvement for government take, and if so, is it such an improvement that you get no investment? Therefore, PNG suffers much worse than having had investment in poor fiscal terms, perhaps. You've just got to get that balance right, and I think that's why I think, as Richard pointed out, engagement with the Chamber, working on maybe a white paper or something to get to really understand what's involved and how the government's present problems can be solved. That's what's really the important step at the moment, rather than rushing into legislation that might lead to a no investment. And I'm not sort of threatening no investment. I think all of the people that work in the investing companies, whether it's myself or people at Exxon or Oil Search or JX Nippon, you'd be surprised when you talk to people. Most people are very bought into the PNG dream. I think we all want to see PNG succeed as a country. I don't think we're here purely just to make money and to leave. We actually want to see the country get ahead and have good development. We actually want to see a PNG workforce that's coming along and is actually internationally competitive. And we look at the projects to date in the mining industry, often well over 95% local content. In PNG LNG already, I think it's 87% national content, and that's a very high-tech engineering project, and we've got a lot of fantastic nationals coming along in that project. The idea is to get these projects up so we can bring more national content in and really lift the capacity of PNG nationals. We don't really want to use expats in PNG if we can get nationals. That would be our preference all the time. So trying to get these projects up, getting the correct amount of training and technology transfer is really what we're all about. But the big but is, if that investor rate of return is not enough, it is just not possible for any of us to get these projects up. I cannot at the moment go to my board of directors with an exploration proposal for Papua New Guinea and say, hey, we should really do this. I see a potential for a big oil and gas field that we can develop. I could say that much of it. But when my directors turned around to me and said, well, yes, and show me how that works on a cash flow analysis and on a rate of return analysis, I would not be able to do that because I don't know what the proposed fiscal system is for Papua New Guinea going forward. So until there's some certainty in that, it's very, very difficult for people, even people like ourselves who really are bought into the PNG vision, it's very, very difficult for us to persuade our corporations to actually invest in PNG. So regardless of our good intentions, and I'm sure people maybe question them sometimes, but our intentions are to try and grow PNG in a positive way. We can't do that unless the equation's right. And so it's just so important that government and industry work together to try and get this framework correct. My personal view is that going the PSC route is not going to help you. Not that it can't work, but it is a very, very complicated route to go. It sometimes works does work in oil and gas projects, which have got a big upfront capital and a big revenue stream. Very, very difficult to make it work in mining projects that have gone ongoing rolling capital. If I had more time, I'd explain, but it's basically to do with the fact that in a mining project, you're constantly having to put capital in, so you don't really get out of cost recovery mode. So the lion's share of the revenue is always going to the investor or the contractor. The state take can be actually quite small in such a regime. It makes these things then very, very hard to administer, because if you get into a PSC in a mining type project, and we've tried this in Indonesia in coal bed methane type projects in the oil and gas sector, which are similar to mining, it's very, very, very hard to get any significant state take. And so these projects you've really got to go through a different mechanism rather than the PSC. I suspect going these ways, going a PSC route on mining will be incredibly problematic for PNG mining industry. Going in petroleum, until you've defined it, we just won't be able to invest anyway. But even once you've defined it, it's going to be very complex to administer. There's a lot of people with a lot of knowledge about production sharing contracts that work on PNG, but there's not a lot of expertise in PNG on production sharing contracts. So if you're going to go that route, I would suggest the government really seeks some good advice, has a big period of consultation, and actually really understands the models they're proposing and how they will enable investment at the same time enabling fair PNG government take.
Thank you, John. And I think you used the term modelling, and I know when you were Minister, you looked at the modelling. Excuse me. So just some concluding remarks on this. And as I mentioned earlier, if we were able to speak to Minister Kua and Minister Marape, give us 3 or 4 points that we could assist in this discussion.
I think the consequences of a poor decision or a bad decision is not just felt by the 33 members of the executive government. It's felt right across the entire constituent representative. So 111 members of parliament will feel the effects of a poor or bad decision. And I think that's critical for us to pick up from and to talk about now, because that consultation process between the executive and the parliament needs to happen. Parliament must immerse itself in the details of the PSC. If it needs to conduct a cost-benefit analysis on that and compare that to the PNG LNG project on its cost-benefit, on a cost-benefit analysis there. It must also look at the plight of the landowner. They may be, they may need the assistance of government through an open book economic model or a financial model to tell them what the value proposition is based on them agreeing to have that type of development going forward. So consultation is key. Consultation in Parliament, consultation with the industry, most importantly, consultation with the landowners, as you will inherently move on to their land for some cases for 30 years, then extend for another 20. Life expectancy in Papua New Guinea, as you will well appreciate, is 54 years of age before an average male dies. Well, if a landowner had 50 of his years of his land been taken off him, he will only enjoy it for 4 years before he passes. Consultation is absolutely critical. So I would appeal to the parliamentarians. Your voices are important. Please speak to the executive government. And the executive government needs to reciprocate and listen to the constituent representative at the same time. Perhaps a select parliamentary committee of sorts could be something that Parliament may consider so that it could immerse itself in the details of this regime, of a new regime that will impact the lives of many more Papua New Guineans, as well as investment coming into this country. So I think I'll end my talk there. Thank you.
Yeah. No, thank you very much. That was most useful. And we have come to the end of our webinar.